What about this headline coming out of Italy and the impact that we're seeing in Europe after this Italian bank share hit here, with the government introducing a one-off 40% tax on profits? Investors clearly concerned about the impact that this is going to have on future earnings and dividend payments. But again, same question here. What's going to happen at the European Open, and do you expect the selling, at least in the banking sector, to continue?
Yeah, look, I think in Europe, it's probably a little bit different, right? Because in terms of let's say, the economic consequences, for example, it is very different between the US and the eurozone in particular, right? In the eurozone, when we look at bank lending to corporates, that still makes up almost 80% of the total lending to corporates, right? It's only 20% that is coming from other sources. In the US, it's almost exactly the other way around, right? We've got almost, 1/5 of total lending to corporates only comes from banks, right? So therefore, the consequences, particularly for the eurozone economy overall, from perhaps banks lending a little less in the next couple of quarters because of the higher rates and because of lower loan demand, especially in the eurozone, that can take a little bit more of a toll, more of a hefty toll for eurozone growth overall, right? It's not only about the banks; it's really about the broader implications from lower loan demand, what higher rates means also for loan supply, what it means for growth overall, right? That really, I think, keeps perhaps recession risks a little bit higher in the eurozone over the next couple of quarters compared to the US. And that overall makes us really a little bit more cautious on European equities. That's why we are, and we still continue to be, underweight overall on European equities and overweight in the US.
Max, just finally, given your overweight US position, where do you see equity sentiment and direction moving from here, particularly as we watch the inflation numbers dropping tomorrow, and of course, given the spike in yields that caused that mini sell-off last week? What are you watching?
Yeah, look, I guess in terms of sentiment, what we are still seeing on our measures is that real money investor sentiment keeps being bearish on equities and on high yield credit, right? That's including the outlooks for the second half of this year. Yes, they've sort of upgraded a little bit those views, but on aggregate, it's still pretty downbeat on equities and on high yield credit. So that means that any kind of dips are still buying opportunities in our view, right? And I think the risk is still higher that we get a sort of 2022 style sell-off if indeed US inflation does reaccelerate more than consensus thinks, right? Because that's not really on the cards of investors, right? On cards of investors right now is this sort of continued Goldilocks theme. But we still really think that this is only really a risk towards the end of this year, right? Not something for the next sort of 2 to 3 months, but really more towards the fourth quarter.